Hey everybody, one of my favorite stocks in the market, SoFi, recently reported earnings. It's not my largest investment, but it's definitely a substantial one in my portfolio. Ticker symbol is SOFI. We just heard their first quarter 2025 results, and I'm pretty happy with the numbers. So we are going to go through them, and I'll show you all the reasons that I like this business going forward. Um, Before we do, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel for the top 10 stocks to buy right now. And I will put that link in the description of this video as well. And stay tuned after the video for a message from the Motley Fool. So let's go ahead and share some of the latest numbers. I just want to talk briefly about a few different things. So we'll start with this. This is SoFi's membership growth. So you can see the membership base has roughly tripled in size since the end of 2021. 2021, of course, was the year SoFi went public. It was part of the big SPAC movement in that era. And a lot of people thought its momentum would fizzle out. A lot of the ex-SPAC companies did, but that really hasn't been the case. Of course, the growth rate has slowed down a little bit year over year as the business scaled, but that is okay. In the first quarter, SoFi's membership base grew 34% year over year, and that 802 million new members is the highest total the company has ever added in a single quarter. So SoFi's momentum has not gone away. As far as profitability, it's looking pretty good. Adjusted EBITDA keeps going up and up and up. You can see where that went since 2020. It's between 2021 and 2024. It's increased by about 33 times where it started. It's expected to get even higher in 2025. And in the first quarter of 2025, that is a pretty substantial gain. And margins continue to expand. If you see on the bottom here, went from a 9% adjusted EBITDA margin in 2022 to 21% to 26% and now to 27%. That is really, really encouraging to see. And on an actual profitability standpoint, on adjusted net income, which this corrects for one-time items and things like that, we can see that 2024 was SoFi's first full year of profitability in terms of the bottom line. And 2025 looks like it's going to be even better. The numbers did not disappoint at all. So it's really the reasons driving the improved profitability and growth that are encouraging to me. So we'll start with fee-based revenue. So SoFi has done a great job, and I'll talk about one of the big ways in a minute, of focusing on revenue that's based on fees, not based on just interest income like most bank earnings come from. So interest income is the majority of the dark blue in this mix. So for the first few years, it was roughly 3/4 of SoFi's revenue was not fee-based. It was pretty much everything else, mostly interest income, but not fee-based. And that mix, you can see over the past few years, has really started to shift. It's now less than 60/40 in favor of other revenue. The reason fee-based revenue is important is that it is very capital light. They don't need to tie up a lot of their own capital. They don't need to take a lot of risk in order to generate fee-based revenue. So we'll look at some of the ways that SoFi is doing that in just a little while. But for now, that is a very, very encouraging trend. You can see the adjusted EBITDA margin. This I already talked about, but here it is just all by itself, just the trend. The first three are full years, so 2022, 23, and 24. This is just showing that it's even better progress in the first quarter of this year. So adjusted earnings per share. This is the adjusted net income just on a per share basis. You can see 2024, first full year of profitability, and it's looking to almost double that in 2025. The management recently increased the guidance because the start of the year is going so well. Tangible book value. Essentially, tangible book value for a bank is what you would have left if you shut the doors, closed the business, and sold everything, theoretically. So you could see how that kind of increased a little bit over the first few years, really shot up last year, and the bank continues to add to that. They expect to add up to $600 million to tangible book value this year. So that's still growing very, very strong. And here's one of the ways that SoFi has done a great job of increasing fee-based revenue. This is a kind of chart of SoFi's lending model. So historically, SoFi made loans, held them on its balance sheet, collected interest income. It still does that in a lot of ways. You can see right here. This is personal loans, student loans, home loans, and credit card loans. It does hold quite a few of those on its balance sheet. It also has some other. It's been selling loans to buyers. Most of the SoFi's loans on its balance sheet are listed as held for sale, not held for investment, which gives it the ability to sell those, especially the first three types. But it's the bottom two that are really interesting here. The loan platform business, where SoFi originates loans on behalf of third-party partners and gets a fee in exchange for doing that. Or if it doesn't meet SoFi's predefined loan criteria, it will refer customers to third-party partners directly, and SoFi can apply, or customers can apply for loans there. And again, SoFi gets a nice little bit of fee income for it. The two loan types in particular that are really interesting to watch right now are student loans and home loans. Personal loans still make up the vast majority of SoFi's business. The company started out as a student lender, but during the pandemic, when student loan payments were paused, no one really had a reason to refinance student loans. Refinancing is really its bread and butter. But we're starting to see that come into play again. You can see the difference between 2024 and 2025. These are the first quarter originations in student loans in 2024 and 2025. Big jump right there. And in home loans, which is still a very small part of the business, you can see a jump right there. These are really interesting for a few reasons. One, student loan collections just restarted, literally the day before I recorded this. The student loan system is still in flux. Forgiveness efforts have pretty much kind of died down to the wayside. It's creating a lot more demand for refinancing, so that could be an increasingly big part of the business going forward. For home loans, it's even more interesting, especially when it comes to refinancing. Americans are sitting on about $35 trillion of home equity. That's the highest level in history. And right now, interest rates are high. So this growth you see right here in the chart between 2024's first quarter and 2025's is in an environment where interest rates were roughly the same. We haven't really seen mortgage rates come down that much. But if we do, so look at the numbers back from 2021 when the home loan business was relatively a small part of the focus. So this is just because interest rates were low and it was really easy to get people to refinance and get mortgages and things like that. So as interest rates hopefully come down later this year, which is widely expected to happen, I can see that becoming an increasingly big part of the business, like I said, especially on the refinancing side. So that's also really, really interesting to watch going forward. Credit quality has improved. That's another really interesting statistic. This definitely contributes to the net interest margin. So if we look at just this line right here, is SoFi's personal loan net charge-offs. You can see a clear 4-quarter trend of declines, and this is in a time when people are concerned about the health of the consumer and the ability of consumers to pay their bills. You can see the bottom line. This is why the student loan business is so appealing. This is the charge-off rate in student loans, well under 1%. There are a few reasons for that. Student loans generally aren't dischargeable in bankruptcy. They're tougher to get out of paying than personal loans. So you have that down there. That's what makes that business very, very attractive right now. Net interest margin, I just mentioned, went up significantly. SoFi's bank continues to gain traction. Remember, SoFi just got its banking charter at the beginning of 2022 and has grown it from zero in deposits to about $27 billion. And deposits now make up about 90% of its funding. Ideally, we'd like that to get to about 100, but this is really encouraging progress. So if you just look where it's come since 2023, and it is still growing very, very strong. So there's a lot to like about SoFi. One thing that I would mention is that SoFi is still a pretty small bank. Management's mentioned that its goal is to be a top 10 U.S. bank. just for context, the numbers 9 and 10 U.S. banks are Capital One and TD Bank. And in order to break into that list, SoFi would need to more than 10x its total assets from current levels. It does have a ton of momentum. And even if it gets there, it would probably be a more profitable business than the companies that are already there. It has higher net interest margins than the average bank because of its branchless structure and online operations. And its asset light businesses that are growing really fast give it a big edge. So there's a lot to like about this. I thought SoFi's quarter was a very, very strong one. Um, I'm still buying the stock in 2025, adding to my position. I'd love to hear what you think. Leave me any comments you have in the chat and stay tuned for a message right now from The Motley Fool. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.